Let's now attempt the question. So you have to remember the rule that start. You have to remember the rule. The rule says that on the first year, you have to start from where the business began its operation. And the question told us that the business commenced on 1st October 1998. So we come here and we say year of assessment. We have the basis period and we have the accessible profit. So the first rule is that we should start from where the business commenced to the next 31st December of the same year. So we start from 1st October. So we start from 1st October 1998 till 31st September, 31st December 1998. This is what the first rule is saying, and the year of assessment is 1998. We have 1998 because the first year are usually on actual year basis. That's why we still have 1998 and still have 1998 here. And if you look at the question, there is no 1998. We only have 1999. There is no accessible profit for 1998. But what we are going to do is that if you count from here, from October to December, you are going to have 3 months. So in our working, we are going to say 3/12 times 180,000 naira. Because we are taking that profit from the next year. Since that they did not give us any accessible profit for the 1998 year of assessment, it means that the operating result of that 1998 has been included in the preceding year, in the other year, which is 1999. So we say 3/12 times 180,000. And when we use our calculator, 3/12 we are going to have 45,000 naira. So it means the accessible profit here will be 45,000 naira. That is for the first year now. The second year, according to the rule, is that we will start from when the business start or commence to the next 12 calendar month. So the second year will start from 1st October. Yes, we start from 1st October 1999 till 1998. Business started here, so 1998. We have to count on next 12 months. And if you are counting from here to next 12 months, you are going to have 31st September 1999. If you count from here, it's going to give you 12 months. If you count from October to this September, it's going to give you complete 12 months. Then this is the basis period now for 1999. And this is the year of assessment. We have to go back to the question and check where we are going to find this basis period. And if you look at the question, 1999 is under here, and the year end is also started September 1999. And here it is complete 12 months, and in our basis period, it is also 12 months. So it means we have to take the whole 180,000 naira. So come over to this place and write 180,000 naira. On the third year, the commencement rule is that the third year is going to be on preceding year basis. Remember that the first year and second year were computed on actual year basis. So the rule now is saying that the third year is going to be on preceding year basis, which means the third year, the year of assessment, is going to be 2000. And since the year of assessment is 2000, the basis period must end in 1999. Refer to my previous video when we talk about actual year and preceding year basis. It will help you to understand this. So now, since the year of assessment is the year 2000, it means that the year end here must end in 1999. So we have it as 1999. Here we see the September. We have 30, and when we count back to next 12 months, we are still going to arrive at 1st October 1998. If you count from here back, you are still going to get back 12 months. So this is so now on the third year now is on preceding year basis. Then we'll go back to the question and look at where we are going to see this basis period. But you can see that this basis period and this one is still the same thing. So it means that the assessable profit for both the second and third year is still going to be 180,000 naira. So you have to take note that the third year are always calculated based on a preceding year basis. So now this is the requirement of the question. The question told us to determine the basis period and the assessable profit for the first 3 years, and this is the first 3 years. But under this commencement, the taxpayer usually have what they call right of election. What they call right of election. Under this right of election, the taxpayer have right to ask the tax authority either to assess him to tax or to subject him to tax using this normal basis period, or to subject him to tax on actual year basis period. Because under this right of election, the third year is still going to be on actual year basis. You remember that here, this is the actual year, this is the actual year, but under this place, it was on preceding year basis. But under this right of election, both the first, second, and third year, all of them are going to be on actual year basis. So the taxpayer is going to compute 2 of them, and then the one that is lower is the one that is going to ask the tax authority to assess him based on. So now let's look at the right of election and see whether we are going to get something different. Okay, so under this right of election now, the commencement rule still follows that you have to start from the day that the business commences its operation to 31st December of that the same year. So we have it that the basis period will be, we have the year of assessment, we have the year of assessment, we have the basis period, we have the assessable profit. So now, starting from where the business commenced operation, the year of assessment, which is 1998, the basis period will still be the same thing because the business commenced here. We say first 10, 1998 till 31st December 1998. And the assessable profit will still be the same, which is 45,000 naira. It will not change. Then on the second year now, because under this right of election, everything is based on actual year basis. Since everything is based on actual year basis, the second year now, which will be 1999 year of assessment, the basis period will start a day after this month. And the day after this month will be 1st January. Will be 1st January 1999 the 31st December 1999. This is what actual year basis means. If you have to start from here and begin from the next day, which will be 1st January 1999, to the next 12 months. And then we have to go back to the question and to see where we are going to find this basis period. And when we come over to the question, this place ended in 1999. We can see that in our question here we have started, the year end was started September 1999. But in our own, we have our own run from 1st to December. But the question stops at 30th September. So it means that what we are going to do here, we are going to say, in our work, we are going to say 9 over 12. Because the question ended in September, which is 9 months. We say 9 over 12 times the amount, which is 180. Which is 180,000. Let's see what it will give us. So 9 over 12 times 180 it will give us 135,000. We have 135,000. The next, but it's still remaining 3 months to complete it to 12 months, because from here to here is 12 months. That next remaining 3 months, we take it from the operating result of the next year, which is year 2000, and is 210,000 naira. So we will now say 30 over 12 times 210,000. Let's calculate it. 3 over 12 times 210. We have 5,500. 5,500. So we now add the two. When we add it, we have 7,500. So this is the assessable profit for the year 1999. So we come over here and write 1,875,000. This is the working we need to do for this year. Then for the third year now, under the third year, the business will still start from here. And when the business starts from here, we now have for year 2000, it will start from 1st January 2000 to 31st December 2000. Then go over to the question to see where this basis period fall under. And if you look at under year 2000, the accounting year end also ended in 30th September. But in our own basis period, it ended in December. So we still follow the approach we did in the first one. We are still going to say 9 over 12 times the operating result of 30th September year 2000, which is 210,000. We have 210,000. And when we calculate it, let's see what we have. We have 9 over 12 times 210. We are having 1,575,000. But it's still remaining 3 months, because from here to here is 12 months. The next 3 months, we take it from the profit of the next year, which is year 2001. Year 2001. So we are going to take the next 3 months from here. So we now say 30 over 12 times 150,000. Let's calculate it. 3 over 12 times 120,000. Sorry, 150,000. We have 37,500. Let's add it and see what we have. We are having the total of 195,000. It means that the assessable profit for the year 2000 under actual year basis or right of election will be 195,000. So now the taxpayer will now look at the assessable profit under normal basis period and the assessable profit under right of election, and then make his decision. You can see that under normal basis period we have 45, we also have 45, we have 180,000 here, here we have 187. So here is higher. Here we have 180,000 and here we have 195,000. What it means is that the taxpayer should continue to pay his tax based on the normal basis period. But assuming that the assessable profit here is lesser, the taxpayer will have asked the tax authority to assess him to tax based on his right of election. So this is how to solve problems or question under commencement, following the commencement rule. In our previous video, we are going to look at, in our next video, we are going to look at change of accounting date. How to calculate the basis period and the assessable profits when there is a change in accounting date. Until we meet again in our next video, please bye for now.